I guess we are live. Let's see. Hi, folks. Good evening. This is Vishwajit. We'll give a couple of minutes for people to join in, and then we'll get started. If you can, in the meantime, give me a thumbs up if you are able to hear my voice, and if you can see me clearly. All right. Awesome. Awesome. Cool. So I'll give one more minute for folks to join in. So while we wait for people, it's Saturday, it's weekend, I know. And it's very difficult to, after a busy work week, it's very difficult to spare some more time on something as boring as taxes. But hopefully we'll try to kind of make it interesting. I've been running Quico for the last 10 years, so hopefully try to share some anecdotes, some stories about, customers, their tech stories. Hopefully we'll make it fun. While we are at it, we'll try to make most of, how you can be more tech savvy this tech season. So let's just wait for one more minute and then we'll get started. Awesome. So I think it's 4:05. We can get started. So good evening, folks, again. My name is Vishwajit. I'm founder at Quico.com. For those of you who don't know Quico, we are an online text platform. We are one-line pitches. We help people save, pay, file, and track taxes. And over the last several years, we have partnered with IFL Securities to simplify taxes for people who are investing, trading into stock markets. Now that audience has grown exponentially over the last 4-5 years. Like a lot of us during COVID times found time. All our discretionary expenses were close to zero. We were not traveling, we were not eating out. So a lot of people started investing. A number of demat accounts in India went shot up from somewhere around 1.82 crore in 2019 to roughly 10 to 11 crore as per the last data published by SEBI. So now all these people are entering capital markets. A lot of them are new investors. A lot of them are coming back to the capital markets. One thing that is constant is taxes. And oftentimes people overlook taxes when they are investing into stock markets. So today, hopefully, we will kind of untangle some of those taxes around investing and trading so that you can file your taxes with ease and confidently. And another thing, like taxes should not be on your mind just in month of July. It should be on your mind around the year. I was just sitting with one of my colleagues the other day, and we were both looking at our Form 16s. And we both make pretty much same income. However, I ended up paying some 50,000-60,000 rupees in taxes, while he was paying zero in taxes. So that conversation led to how throughout the year he was continuously planning his taxes. Of course, it's it doesn't look good on me. I run a tax platform saying this, but primarily he was able to spare some time and be more tax efficient while I was not. So hopefully today we're gonna share, some tips, tricks as to how you can be more tax efficient. So, all right, let's get started. So, like I said, Quico enables individuals and businesses to save, pay, file taxes. Today we serve over 2 million individuals and small businesses. You can find us on Quico.com. We have a mobile app called Glide. We also have an online tax advisory called Meet. Now, Meet is where if you don't want to do your taxes yourself and you need help, you can connect with a tax expert through a video conferencing call just like this, and using our interfaces and products, they'll help you do your taxes. I think we can go to the next slide. So what's the agenda for today? We are meeting in first week of July, almost at the end of the first week of July. And this is tax month, folks. India tax filing season starts in April, ends in July. Most of India files their taxes in July. So between now and 31st July, roughly 7.5 crore tax filers will file their taxes. That means there's a lot of chaos. A lot of people are stressed about all their documents and where to go and how to file their taxes. So hopefully we'll answer some of those queries, whether you do it through Quico or otherwise. Hopefully we'll be able to take some of that stress off of your plate. So we're going to talk about, start from very basics and very quickly fast forward to some of the topics that you are interested in around investing and trading and what are the tax implications on it. And then we'll end with a small, Q&A where I'll answer any questions you may have. So what is ITR? If we can just go back one slide. So we're going to cover what is ITR. We're going to talk about due dates. We're going to talk about income heads. Losses is something very commonly on people's mind when they're filing their taxes. What to do about them? Do they need to report if they have incurred losses or not in their income tax returns and things like that? So I'll answer hopefully some of those queries. Audit is another taboo topic. There's not a lot of clarity around it, but hopefully as an engineer, I'll not use jargon and simplify audit rules so that you can determine whether audit is applicable to you or not, and you can find the right auditor. And then I think common mistakes to avoid while filing your ITR, because hundreds of thousands of people use Quico, be through Twitter messages, through tweets, through other social media handles, through our support center. We get a lot of insights into what problems people run into. Oftentimes, because we are building tax platforms, we are biased. We overlook those obvious things. But when we talk to customers, when we go sit along with a chartered accountant in an advisory, we get to hear all this stories about how whether somebody paid advance tax or self-assessment tax for the wrong year, or they put it in they paid the taxes under wrong bucket. Where they didn't know how they could recover out of it, right? So we'll share some of those stories and how you can avoid those mistakes yourself. And then very quickly talk about documents. We all know, I know people, including in my family, my parents, they have files for all their tax documents, and they throughout the year painstakingly collect all the documents and file them. However, I was just showing my friend the other day that if you use the right platform, now income tax department has all this data, and you can just simply autofill all the details by just giving Aadhaar OTP consent, and 95% of that data gets autofilled into your income tax return. Now that's also available on income tax portal, but it's also available on platforms like Quico. So you're going to talk about it, and very quickly I'll show you the demo of the app. So cool. What is an income tax return? Oftentimes people, between 25th and 31st July, almost 70% of income tax returns get filed in India. Now, I'm not boasting about it. I think we should all file in time. I don't think we should wait till the last moment. I'll tell you a few advantages of filing early. For instance, as you get closer and closer to the due date, your margin of error drastically reduces, right? If you don't have documents, if you incorrectly report something, if you need help, it's very difficult to find it in those last few days. That's number one reason why you should file in time. Also, I think filing early is also problematic because a lot of time your employers haven't reported the TDS, they haven't filed TDS return. Yet all the tax credits haven't reflected in your Form 26A. So I would still say wait it out till 15th June, which is the due date for employers to issue Form 16. But you should definitely file between 15 June and 15 July. That's when I file my income tax return. The second reason you should file early is because as you file late, income tax department is also backlogged with tens of millions of income tax returns to process. So that slows everything down. However, income tax department has made great strides. Last year, finance minister in the budget said that an average ITR processing time had reduced from some few weeks to less than 7 days, and average refund issuance time had reduced to some 3 or 4 days, right? So that's great. But let me tell you, if you file early, those numbers will be real numbers. Like you will get your refund in under a week. But if you file like in the very end of the tax filing season, then highly likely that your income tax return will get processed along with tens of millions of other income tax returns. So that's the second reason why I would recommend you file a little early, right? Okay, cool. ITR forms, there are 7 forms. I think as individuals, we primarily care about 4 forms, ITR 1 through 4. In the later slides, we'll talk about what are those forms. But all individuals and HUFs earning, gross income that is above basic exemption must file income tax return. What is basic exemption? Under new regime, which is now the default regime, the basic exemption is 3 lakh rupees. Earlier, it used to be 2.5 lakh rupees under the old regime. All right, let's go to the next slide. Why now? I already talked about why you should file early, but let's also cover why you should file ITR, right? So these are very common things. A few misconceptions people have that I would like to call out is oftentimes people think that if because TDS is deducted, they don't need to file income tax return because all the taxes have been deposited. But let me tell you, that's not true. Even if all the TDS is deducted from your salary, you still need to file income tax return. If you don't file it in time, there are, let's say if TDS was sufficiently deducted, then there are no interest penalty because you don't have any outstanding tax liability, but there are still late filing fees if you don't file by 31st July. So you must file income tax return. Now, let's say what if you had paid excess taxes, right? More than you actually had to pay. Then in order to claim refund also, you must file income tax return. You will not get refund without filing an income tax return. So that's one very important reason why you should file your income tax return. Now, if you're a trader, investor, now last year markets have been good. I see a lot of investors have made profits, but in a volatile year, if you incurred losses, then unless you file your ITR, you will not be able to claim benefits of those losses, right? So what are the benefits? How to claim them, that's something we're going to talk in later slides. But if you want to claim benefits of carry forward losses, of the losses, then you will have to file your ITR. I already talked about avoiding penalties. And I think it's in general a good hygiene, a personal finance hygiene to file income tax return because it kind of gives you a moment to pause and reflect upon your incomes, your expenses, your insurances, your investments, right? So it's a great kind of activity. I would suggest do it quarterly, but if not quarterly, at least doing it once a year. And income tax return gives you that great opportunity to go back and reflect upon all your personal finances. What I I use it to also organize my other personal finances. Like when I'm filing my taxes, I'm also making sure I'm revisiting my investments, I'm rebalancing my portfolios, I'm re-looking at my insurance needs. So it's usually a good kind of milestone where you can go and overall be more, more hygienic about your personal finances. And then it acts as a legal document in various things. If you opened a demat account lately, then in order to activate segments, it acts as an income proof, for, of course, for home loans and visas and things like that. It's an important document to have handy. Awesome. So kind of anecdotally, we get a lot of customers when exactly they want to get a home loan, they show up on our platform and they say, yeah, I haven't filed income tax returns in the last few years. Can you file it right away, right now? Right. And that oftentimes is not possible because nowadays you can only file income tax return for current assessment year. And if you want to file income tax return for previous assessment years, either you can file, something called ITRU, or you will have to go back to assessing officer and request them to allow you to file income tax return. So that usually does not fall in line with, for example, if you are looking to get a home loan, looking to close a transaction, a financial transaction, then it will not be timely. So I would suggest you don't kind of run at the last moment when you need the income tax return. It's just good hygiene to file it every year. So it's handy when you need it. Now, ITR filing due dates for individuals who are salaried, who are investors, the due date is 31st July. So for most of us, out of 8 crore income tax returns that get filed in India, roughly 95% folks, the due date is 31st July. It's only people where audit is applicable, the due date is 31st October. And then the last date by which you can file income tax return for this year is 31st December. So 31st July is the due date. And after 31st July, you can file up until 31st December, but it will be considered a belated return. There are certain disadvantages of filing a belated return. Of course, apart from incurring interest penalties, there are other disadvantages as well. So I wouldn't take chances and file post 31st July. Great. Let's go to the next slide. So these are the 5 heads of income. I think everybody knows these. There's so much content online. So I'm going to quickly skim through it. So salary is very well understood. My father is a pensioner, so pension also is considered salary income. If you get family pension, however, that means you get pension for a family person, a family member who is deceased. Then in that case, it will be considered income from other sources. But if it's your pension, then it's still considered salary income. Income from house property is pretty straightforward. You can have 2 kinds of house properties. One is self-occupied, that means the property that you live in, and the other one is let out. That means you own a property and you've rented it out. Now, why do you ask, why do I need to report the property that I live in? You don't need to report it if you don't have a home loan. But if you have a home loan, there is a benefit of, like if under old regime, there's a benefit under ATC, where you can claim principal as a deduction, and there's a benefit under section 24B for any interest that you paid on home loan as a deduction on your income tax return. So if you have home loan, then and then only you need to report the self-occupied house property. Otherwise, you don't need to report it anywhere. And then let out house property, because you are earning rent income. In a lot of cases, your tenant might be deducting TDS. Then it becomes compulsory for you to report that kind of income, that kind of house property. Now, income from business profession. If you are a sole prop, you are using your PAN, you have registered a sole proprietorship, you are running a small shop, you are running a private practice, you are you are a tech consultant or a designer or a professional like doctor or lawyer, then all of those incomes get clubbed into income from business profession, right? So also, if you are intraday or FNO trader, it's also considered business profession income, because you are using your capital to you are essentially doing all the things that you would otherwise do while running a business. You will invest into financial instruments. You will track the trends. You will monitor the market fluctuations. You will observe the macro and microeconomics. You might incur expenses, like you might have an office from which you are doing trading and things like that, right? So it's so trading activity also falls into income from business profession. So we'll talk about it a little more when we get to trading income. Now, income from capital gains. So if you sell any capital asset, so what is capital asset? Shares and securities, bonds and debentures, mutual funds and ETFs. These are called securities capital assets. But then you also have real estate like house property or land or building. And you can also have other kind of capital assets like jewelry, art, machinery, things like that. So if you sold any of these capital assets, then you might incur either capital gains or capital losses, right? So if you sold it at a higher price than you bought it for, then you will incur capital gains. If you sold it at a lower price than you bought it for, then you will incur capital loss. So that's called income from capital gains. And then last but not the least, income from other sources. So a lot of very common incomes fall under income from other sources. Things like dividend income, right? A lot of us are investing into stocks, mutual funds that yield dividend. That goes into income from other sources. Savings interest are another very common, FD interest, PPF interest, all the fixed interest schemes, their interest is kind of reported under income from other sources. All right, let's move on to the next slide. Now, how are capital gains taxed, right? Because we are talking about, you all are IIFL Securities customers. So I'm hoping some of you are investors. So let's take a look at how capital gains are taxed. So like I said, capital gains, capital gains incur when you sell any capital asset, right? So let me bust few myths here. So oftentimes people feel that, when let's say family member gives them shares, they will have to pay taxes. Or when, their employer issues them ESOPs, they'll have to pay taxes. Or when a company issues issues additional shares in form of, bonus or things like that, they'll have to pay taxes. Not true. You only have to pay taxes when you sell those capital assets or sell those shares or RSUs or ESOPs, right? So if you haven't sold anything, don't worry. You don't have to worry about capital gains. But if you have sold any of these capital assets, then you have to be mindful of, what used to happen in earlier years when I started Quico, roughly 10 years back, is because the income tax department also did not have a lot of data around these kind of activities, financial transactions. So a lot of chartered accountants and a lot of people used to report it into income from other sources and things like that, right? But now, because all of this data flows back to income tax department, you could also verify it in something called AIS, annual information statement. It becomes ever more important to report it into right heads, report it into right buckets with the right tax treatment. Because otherwise, they just do data mining. When you report your income tax return, they do data mining on your income, all the data that they have on you versus the income tax return that you have reported, and programmatically, they will send you out a notice of defective return, right? So I get a lot of customers, my team gets a lot of customers where people are used to doing things certain way, and they feel कि पहले नहीं करना पड़ रहा था, अब क्यों करने की जरूरत है, right? So the common answer is earlier systems data was not connected. If you know, over last couple of years, roughly 100 crore Aadhars got linked to roughly, I think there are 35 crore PANs. So all the Aadhars and PANs got linked, right? Now, what that means is, when you open your bank account, you gave your Aadhar now or gave your PAN, now all that data is linked. If while opening a Demat account, you gave your Aadhar, or while borrowing money, you gave your Aadhar, then all of that data is now linked with your PAN, and that data flows back to income tax department. So it becomes all the more important to report on these kind of financial transactions. By the way, I mentioned AIS, annual information statement. We'll also talk about it. It has become the most important document. We'll talk about it in one of the latest slides. So now let's quickly cover this slide. So if you look at the table here, the first column is all the different capital assets that I just mentioned. The second column is holding period. So the way capital assets and any gains from this capital assets are taxed is based on the holding period, right? How long you hold them. And the third column is the tax rate. So domestic listed shares, equity, MF, ETF, which is the primary interest for everyone here. If you hold them for less than 1 year, it's considered short-term capital gains. If you hold them for more than 1 year, it's considered long-term gains. And tax rate for short-term gains is 15%, and tax rates for long-term is 10%. Now, some of you might ask, hey, that's not true. There's a 1 lakh rupee exemption. So you are absolutely right. For listed shares, there is exemption under section 112A up to 1 lakh rupee, right? I think somebody's saying slide is not visible. Can others confirm if you are able to see the slide? You are able to see the slide? Okay. So you might want to rejoin if you are not able to see the slide. I was talking about domestic listed shares, equity, mutual funds, and ETFs. So like I said, if you hold them for more than 1 year, it's considered long term, and under section 112A, it's you get exemption up to 1 lakh rupee, right? So now you might have heard an idea called tax gain harvesting, right? So what oftentimes people do is towards the end of year, if your gains are less than 1 lakh rupee, then you can harvest those gains. What do you mean? You can realize those gains by selling off those positions and then reacquiring them. If you feel, if your conviction is still there in that script, you can reacquire it, retain the portfolio that you had, but you get tax-free capital gains, right? So now anything above 1 lakh, people get confused. So if it's more than 1 lakh, you still get up to 1 lakh rupee exemption, and then anything above 1 lakh will be taxable, right? So if you see the tax computation, you will see that your capital gains, let's say you have 2.5 lakh rupees long-term 10% capital gains, the first 1 lakh is tax exempt, and the remaining 1.5 lakh will be taxed at 10%. Now, foreign unlisted equity shares, equity shares or unlisted equity shares. Now, a lot of platforms started supporting, investing into foreign capital markets. So, if you are somebody who's investing into foreign capital markets, or if you are somebody like me who is running a private limited company and you have unlisted equity shares, then in that case, the holding period is short term if you hold them for less than 2 years, and long term if you hold them for more than 2 years. And there is slab rate, which is just like your salary income or other income sources. The slab rates will be applicable on that kind of capital gains. And if it's long term, it will be 20% with indexation. So there are a few learnings here. First question might arise that, why domestic listed shares say unlisted equity share ka treatment different hai, right? It's primarily because when you trade on Indian exchanges, you also pay something called STT, security transaction tax. So you're already paying some taxes. Which is why the tax rates are a little lower. If you see, short term is 15% and long term is 10% compared to unlisted share, where you are not paying any taxes. When you are you're paying to local bodies, right? You pay stamp duty and things like that. However, you are not paying any taxes to central government. So, which is why there are higher income tax rates. The other question you might have is, what is indexation, right? So this is an interesting concept. So just like inflation, every goods or consumables you consume, their prices increase with passing years because of inflation. Same way, capital assets also their prices increase based on inflation, right? So if you purchase a property in 2010 for, let's say, 20 lakh rupees, it might today cost 35 lakh rupees, right? So what income tax department is doing is giving you benefit. If you bought something in 2010 for 20 lakh rupees and you sold today for, let's say, 50 lakh rupees, then your gains are not the difference, which is 50 minus 20, 30 lakh rupees. Your gains are essentially a difference between your sale value, which is 50 lakh rupees, minus the inflation adjusted price, which is 35 lakh rupees. Hence, your gains are only 15 lakh rupees, and you'll have to pay taxes on those 15 lakh rupees. So that's the concept of indexation. If you want to learn more about it, I'll ask Keshav to bring a text Q&A thread where we answer these kind of queries. Now, debt MF ETF. Recently, only Finance Minister, last year, I guess, Finance Minister announced few changes. So now all the debt mutual funds, ETFs that you purchase post 1st April will be deemed short term and they'll be taxed at slab rates. Now, hybrid funds, we invest in a lot of different kind of asset allocation. Some people like to invest in equity, some in debt. Based on the different risk tolerances and your kind of financial goals. Oftentimes, people also invest into hybrid funds. So, in case of hybrid funds, if the fund has more than 65% equity, then it's considered equity fund. If it has more than less than 35% equity, then it's considered debt fund. But if it is between 35 and 65%, then it's considered hybrid fund. And in that case, the holding period, if you hold it for less than 3 years, will be short term, and the tax rate would be slab rate. And if you hold it for more than 3 years, it will be long term, and the tax rate will be 20%. All right, so let's go to the next slide. I see some of the questions. What I'm going to try to do is answer some of them if they are, directly connected to what we are discussing. And otherwise, at the end, Keshav will help us compile all the questions and we'll go through them. Let's see, how are we doing on time? So we are at the halfway mark. So I'll try to get through all the slides. So how are trading profits taxed? I hope everybody is tuned. Everybody is understanding what I'm saying. Please, let me know if you want me to speak in Hindi or otherwise, so that more people can engage and understand what's happening. So what are how are trading profits taxed, right? So Vishwajit, you talked about stock market investing, right? But what about people who are doing futures and options and intraday trading? Now, how do you differentiate between these two? Of course, futures and options are different kind of financial instruments, so they are easily identifiable. But intraday, just like you play a cash trade, you place a cash trade or a delivery trade, just in a similar fashion, you place an intraday trade. So why is it different? So like I said, okay, when you are investing with a long horizon. You want to take advantage of the capital appreciation. You are a believer in a business, right? Which is why you are called an investor. But for example, when you're getting in and out of a stock because you see certain news coming out or you are anticipating the quarterly results to be certain way, or you have analyzed certain market trends, or you've researched about the sector and you are bullish or bearish about it, and you get in and out of stocks because of this daily price fluctuation, then you are considered an intraday trader, right? Now, intraday trades are set of every day. So their holding period is usually less than 1 day. And those are considered speculative business incomes. They are not considered capital gains. Now, somebody might say, I'm an investor, Vishwajit, and this one fine day I entered the script, but then I decided to exit it very quickly, and I placed a sell trade before the end of day. So in that case, as you can understand, today in India, the T+2 delivery happened, right? So you cannot place an investment trade on a same day and liquidate it on the same day. However, if you still feel that your intent was to invest and not to trade, you can still report those kind of activities onto capital gains. What I would suggest is you keep your reporting consistent. That means, sometimes what happens is, because capital gains are special rate taxes, let's say 15% short-term tax rate, and somebody has 10-12 lakh rupees income, and hence they see a slab rate to mera 6% 7% ho raha hai. So I would start reporting it as a business profession income. And the next year, when you have higher slab rate income, you start reporting it as a capital gains income, because that's more beneficial. I would strictly resist doing that, because when you flip flop your reporting situation, then it kind of raises a red flag. There are algorithms written that make sure that people are not continuously switching between reporting it as business and capital gains. So those are the kind of pitfalls I would avoid. Whatever your intent is, if you are an investor, doesn't matter you did intraday trading, you can report it into capital gains. And if you think you are a trader and doesn't matter you held it for 6 months, you are still considered, it's still considered business profession income. So it strictly depends on your intent. Now, however, your broker does not know it. So IIFL Security does not know it, that whether you're getting in and out of market as a trader or investor. So they, in that case, will strictly follow the tax rules, right? So if you hold it for more than 1 day, if it's not an MIS trade, then they will consider it to be short term. If it's held for more than 1 year, it will be considered as long term. And your P&L report, you will get it as such, right? But then when you're filing your taxes, you and your chartered accountant, or you yourself, when you're doing it yourself on a platform like Wipro or on government portals, you can decide what your actual intent was. All right. Now, futures and options, unlike intraday, futures and options are considered non-speculative business profession income because you may end up taking delivery, right? So your goal was not purely speculation, and hence it's considered non-speculative business income. However, the tax rates and tax treatment is exactly identical like intraday. There are few nuances when it comes to losses. We'll talk about those. There are few nuances when it comes to kind of carrying forward those losses. We'll talk about those in more detail when we talk about losses. So I think we can go to the next slide, Keshav. Now, setting off and carrying forward losses. So great. It's a great segue. We were talking about, I think I see a question, NRA demat account linked with, sorry, there's the text is cutting. So I think because we are talking about, there are a couple of NRI questions, I'll very quickly answer it. So in case of NRIs, you need to report only incomes earned in India. So if you have incomes outside of India, you don't need to report them in your income tax return. You only need to report your incomes in India. Now for you, the incomes are taxed exactly just like residents. So if you have capital gains income, if you have, if you have other sources of income like savings interest, if you have sold house property, ancestral house property and things like that, they are reported and taxed just like a resident. There are few benefits that residents get that NRIs don't get. We'll answer those at the end. Now, setting off and carrying forward losses. So, what does setting off losses mean, right? So, let's say you have income, capital gains, let's say in one trade, and you have incurred losses in another trade, or let's say you have capital gains in one demat account and losses in another demat account, right? So you can set off those gains and losses to reduce your taxable income. Now, there are a few rules around it. I don't want to go into those nitty-gritties. If you use a platform, including government portal, it takes care of it for you. So you don't have to sweat too much about it. But I think if you can understand the concept, I think that should be good enough. So if you have, like I said, if you have incurred gains in certain places and losses in certain other places, you can set them off and you can reduce your tax liability. That's called setting off losses, right? Now, you can set off short-term capital losses against both short-term gains and long-term gains. You can set off long-term capital losses only against long-term gains. When it comes to FNO, any losses from FNO, then you can set it off against any other income except salary. And when you talk about losses from intraday, you can only set them off against other gains from intraday, right? So be it from same year, or you carry them forward in the next year, you can only set off intraday losses against intraday profits, right? So these are a few things to keep in mind. I think the last column, like it says, you can carry forward these losses. Now, what is carrying forward the losses? So let's say you had incurred, for example, you had incurred 2 lakh rupees in short-term losses, and you had 1 lakh rupees long-term gains. You set them off. Now you're left with 1 lakh rupees short-term losses, right? So what do you do with these losses? You can report them in your income tax return as something called carry forward losses. And you can carry them forward to the next assessment year. You can do it for 8 subsequent assessment years. And now what do you do with it? So if next year you have incurred gains again, you can set off those losses and you can reduce your tax liability even against future incomes, right? So now, like I was saying, if you don't file before 31st July, you cannot carry forward losses. So if you incur losses and you want to carry them forward so that in future, when you have gains, you can set them off and reduce your tax liability and hence save some on taxes, then you must file your income tax return before 31st July. I think we can go to the next slide. What is tax audit? Now, this is very like it's a taboo topic in the sense we get a lot of questions around tax audit. People get a lot of different advice from different people around tax audit. The Income Tax Act is very difficult to read when it comes to audit. So over years, as we help more and more customers, we have tried to continuously understand these rules. We go ask chartered accountants within our network. What is audit, first of all? So audit is, in certain cases, income tax department wants, someone to look into your books. What are your books? So when you are running a business, you're essentially maintaining ledgers, right? Now, when you're filing your income tax returns, you're using those ledgers to say, this is my income or this is my profit and these are my losses. In certain cases, what income tax department is saying, I want a third party, a chartered accountant, to look into your ledgers, to look at your income tax returns and verify that you have reported everything accurately, right? Now, earlier years, what used to happen is if I am a dukandar, and what I would say is I bought 20 lakh rupees ka inventory and I sold 10 lakh rupees ka inventory out of it, and the other 10 lakh rupees ka inventory barish mein bhig gaya, ya chori ho gaya, right? So and then you can claim those as those losses as expenses on your income tax return and you don't pay any taxes, right? So wo nahi ho, isliye income tax department wants chartered accountants, a qualified chartered accountants, to look at your ledgers, sometimes do physical visits, look at your inventories, look at your financial statements like your books, and basis that submit the audit report. And once that audit report is submitted, is only when your income tax return is processed, right? So audit is essentially an annual activity when a chartered accountant, in certain cases, reviews your books and submits an audit report to income tax department, post which you can file your income tax return. Now, the due date to submit the audit report is 30th September, and the deadline to file ITR when audit is applicable is 31st October. So that itself gives away that first you need to get your books of accounts audited. The auditor needs to file audit report, and then only you can file the income tax return. All right. So that's what audit is. Now let's understand the rules around audit, right? So without going into a lot of complexities, I'll simplify the rule for you. So if your turnover is greater than 10 crore, then audit is necessary no matter what, whether you have made profits, losses, it doesn't matter, right? Audit is compulsory. Now, if your turnover is less than 10 crores, then you have to look at few things. There are two primary things that you need to look at. One is, if your cash receipts are greater than 5%, right? Cash receipts or cash deposits or cash expenses are greater than 5%. That means you run a cash business. It's not a bank business. That means you don't get money, income, or you don't make expenses through your bank account, but you rather do it in cash. If that's greater than 5% of your turnover, and if your turnover is less than 10 crore, then audit is again applicable, right? Because of course, I mean, when you are doing cash transaction, it becomes really difficult for somebody to ascertain your actual profit. So income tax department wants a chartered accountant to look into your business and make sure that you accurately report your profits. Now, if your cash receipts are less than, or cash expenses are less than 5%, then in that case, you only need to worry about one rule, which is, I don't know if you know about presumptive taxation scheme. Maybe I'll try to cover in next slide. But if you, in any of the previous 5 years, opted out of presumptive taxation scheme, right? That means you were taking benefit of the scheme and then you opted out. Then in that case, even if your turnover is less than 10 CR, even if your cash receipts and cash expenses are less than 5%, you still need to get your books of accounts audited, right? So because you have opted out of a presumptive taxation scheme, in that case, they want you to get your books of accounts audited because you've changed the tax reporting that you used to do, right? Now, there are a lot of small nuances that people oftentimes get stuck upon, like 6% say come profit hona chahiye ya loss hona chahiye, tabhi audit requirement hai ki nahi hai, those kind of things. What I would say is this table, you can take a screenshot of it. I think this slide itself is a pretty, I think it covers 99.9% cases. There could be fringe cases where, somebody, because of some kind of fringe subsection, some clause needs to get their books of accounts audited, but otherwise this broadly covers when audit is applicable. Most of us are investor trader. We have bank ledgers. We get P&L reports from our broker. We deposit all the money either via UPI or bank transfers. So we don't need to worry about audit that much. I think last year also the turnover calculation guidelines were changed by ICAI. So now the turnover is not inflated as it used to be in the earlier years. So audit is applicable to very few people, right? So, but otherwise this should be the de facto slide. Okay, great. So I think we have a slide around turnover. So now oftentimes you will say, Vishwet, you said that 10 CR se zyada turnover or 10 CR se kam turnover, but how do we calculate turnover, right? So what is turnover? In a regular business, turnover is, all your sales, right? So let's say if I'm a shop and I sold bananas worth 10 lakh rupees, then my turnover is 10 lakh rupees. It's as simple as that. But in case of, trading business, securities trading business especially, and if you are trading futures and options contract or intraday trades, then in that case, turnover is calculated little differently because you have to understand, right? You are not, when you're buying these contracts, you are only having to pay up the margins. You don't have to pay up the whole price. So the turnover is calculated little differently. So turnover in case of securities trading is kind of absolute values of your realized P&L, right? So like Keshav has mentioned here, if these are your 4 trades and let's say these are your realized P&Ls, 8,000 minus 2,000 minus 15,750 and 10,875, then your turnover is kind of summation of absolute values of all this P&L, right? So let's see if I can see the slide. So like you can see, the absolute values are the positive values, and then you sum it up and your turnover is 36,625, right? So it's pretty straightforward. Sorry, there's, I think, echo. All right, so let's go to the next slide. Look, mistakes to avoid while filing ITR. So we have roughly 10 minutes. So I'll very quickly try to cover this, and then we'll take up Q&A. Hopefully, we'll be able to spend a little more time. So I already talked about missing the due date and what are the side effects of missing the due date. I'll reiterate those ones. So if you miss the due date, then number one, there is a late filing fees under section 234F. It's, I guess, 5,000 rupees if your income is above 5 lakh, and it's 1,000 if it's less than 5 lakh or something like that. So that's number one. Number two, like I said, if you file a belated return, you lose certain benefits. The first and foremost is you cannot carry forward any losses, right? The second thing, the third thing is if you file a belated return and if you had an outstanding liability, then you incur more and more interest, right? Under section 234B. So let's say financial year khatam hua 31st March and 1st April को आपकी outstanding tax liability थी. Now आपने जुलाई में return नहीं file करके December में file किया, so you are having to pay 1% simple interest on your outstanding liability for those 6 months. Every month, not just 6 months, from April all the way to December. So for, I think those months you will have to pay, for those 9 months, I guess, you will have to pay the 1% simple interest. Now, oftentimes people say it's 1% simple interest. I can trade in markets and I can make more money, and hence I don't want to pay my tax liability early and I want to pay it late. But I think what I would say is you pay your taxes and you can still invest into markets and still make those profits. And right, I wouldn't kind of, it's not either or. It's not either you pay taxes or you invest into markets and make profits, right? So don't look at it like that. There are certain disadvantages of not filing or filing a belated return. Like already mentioned, you cannot carry forward losses. And certain cases, losses in a volatile year you can incur losses. It's part of trading in capital markets, and you will lose all the benefits that come with setting off those losses in future years. Now, selecting the wrong ITR form. Now, on most platforms, it happens automatically, except on government platform, you have to choose which ITR form you want to file in the utility. So make sure you understand which ITR form to file. There are a lot of tools online where you can just say what your income sources are and they'll tell you what your ITR forms are. But then ITR forms also change on small nuances. For example, NRIs cannot file ITR 1. They have to compulsorily start from ITR 2, right? Or if your taxable income is more than 50 lakh rupees, then you cannot file ITR 1. You have to file ITR 2, right? So there are those kind of small nuances, but otherwise, you can find answers on ChatGPT or otherwise very quickly as to which ITR form you need to file. Now, selecting the wrong assessment here, it's less problematic nowadays because you can only file for one assessment year. But still, if you go to portal and things like that, you can choose multiple assessment years and you can not just file for current year, but you can also file for previous year, like I was saying, ITR use and things like that. So please be really careful. Current assessment year is AY 24-25. And 31st July is due date for AY 24-25. So make sure you file for AY 24-25. Now, not recording data reported in Form 26AS and AIS. Remember, I was in the earlier half saying that AIS has become the de facto document. Now, what is AIS? Annual Information Statement. How does data go to AIS? So your exchanges, your clearing houses, banks, NBFCs, these are all required. Your employer, they are all required to file one or the other compliance forms, annual information returns, as they are called, AIRs, and report all the financial transactions to Income Tax Department. And that all data flows into something called your AIS. Now, how can you access your AIS? So government has a nice mobile app where you can enter your PAN and Aadhaar OTP and you can get access to AIS. You can also go to income tax portal and access your AIS. We'll put a link to how to get access to your AIS. So make sure you report everything that is in AIS with your income tax return, in your income tax return. So now one thing that is really problematic that is happening, and we have also given feedback to income tax department, is oftentimes income tax department does not have complete data, right? For instance, you sold a mutual fund, they know, but let's say you had bought that mutual fund 4 years back when the AIRs were not there. That means the data was not reported to income tax department. Now they will only calculate capital gains based on your sell transaction, right? So I would be really careful when I'm reviewing my AIS, because the onus of accurate tax reporting and accurate tax liabilities on you and not income tax department, unfortunately. So you have to make sure that if there is a problem with your AIS, there is an option to submit response on AIS itself. If you need help, Team Quico has advisory plans that can help you submit responses. So I recently only met a gentleman where his mutual fund transaction, all the sell transactions were reported, but his buy transactions had anomalies, and hence income tax department has calculated very high capital gains. I think in between it happened to kind of lakhs of investors that they started seeing exorbitant mutual fund capital gains in their AIS, and then income tax department had to go and kind of announce that it was some erroneous reporting from some of these reporting agencies. So make sure you are always in know of your AIS and what transactions are getting reported there. All right, so make sure all the data in AIS gets reported in your income tax return. Now, non-disclosure of bank accounts or any kind of income that you think is not taxable, hence you don't need to report on your income tax return, or you think the income tax department shouldn't care about it. As long as it's a reporting requirement in your ITR, you should report it. So to give you an instance, I have multiple bank accounts, and oftentimes the common tendency for us to do is to report the primary bank account that you use on day-to-day basis, right? Now you might be earning a savings interest and some of those other accounts, and you don't report it in your income tax return. And it's very easy thing to catch, right? Because your bank accounts are linked with your PAN, and the savings interest oftentimes have TDS deducted on it. It also gets reported in your AIS. So these are the common gotchas, right? So I would report as much information as possible in the income tax return. Now, not reporting interest income from savings bank, I think I already covered it. So make sure all of that is reported in your income tax return. Not reporting transactions from multiple demat accounts, we discussed those. Not reporting dividend income. Now, certain cases you will see that if your dividend income is less than 5,000 rupees, there's no TDS deducted on it, right? In a nutshell. So you think because TDS is not deducted, income tax department doesn't know about it. But again, you will be able to see that data in your AIS, right? You will see those dividend incomes, even if TDS is deducted or not deducted. The other thing is, starting last year, you now also have to report dividend income quarterly, right? So that they can calculate advanced tax liabilities on accrual basis. So make sure you report your dividend incomes whether TDS is deducted or not, and make sure you report them in appropriate quarters. Now, improper classification of capital gains, I already discussed when we were discussing capital gains and BNP. So make sure your reporting is in line with your intent. Then not filing ITR when you have incurred losses. We discussed these. Even when you have incurred losses, you need to file your ITR, not because you just want to carry forward losses, but because you might have other income sources that are above basic exemption limit, and hence you are required to file income tax return. Now, most people make this mistake. They file income tax return and they think they're done. But it's only when you e-verify your income tax return is when your ITR is actually submitted, and it's only taken up for processing once you e-verify it. Now, why is that? Because you might file your income tax return through a platform like Quico or through a chartered accountant. So they can submit your income tax return. They can upload your income tax return, but they cannot e-verify it. E-verifying requires your consent. So it's only when you e-verify it is when income tax department considers it to be the final income tax return from you. right? So you have 30 days once you e-file your income tax return to e-verify your ITR. So make sure you don't only A, file your return, but B, also e-verify it. Now, what if you made a mistake, any of these mistakes in your income tax return? So you should not sweat about it. Income tax department also gives you an opportunity to revise your income tax return, right? It's very easy to revise your income tax return. It's just like filing your original return. You just have to put the original file on date and acknowledgement number. Along with that, you can make any changes to your income tax return and resubmit it. Again, you can file a revised return up until 31st December. Okay, cool. So I think we are almost running to the end of time we had. So I think we have discussed these documents. What we can do is we can very quickly look at the demo. I think there are a few questions around how can they file the income tax return. So maybe Keshav, we want to quickly go through it and then we can take a few Q&As. Awesome. So I think we're gonna show, Keshav is gonna share, he has shared a screen, so he's gonna show us how you can file your taxes through Quico. So if you go to IIFL, you navigate to, if it's called Trader Terminal. So if you go to Trader Terminal, there is a tax filing tab. So IIFL team worked really hard to integrate all the reports and everything with Quico, so that you can file your taxes very easily. So from Trader Terminal, you can start filing your return. You click on start here. Now, I was saying you can autofill your income tax return from ITD. You can choose either of the options. Let's connect our income tax account. Now it has autofilled all the information that income tax department has on you. You can review it and you can start your income tax return. So this is, 80% of your income tax return is already ready even before you enter any information. So your salary, your tax credits, your deductions, your bank accounts, your other incomes, everything is pre-filled as per your AIS. Now let's go to capital gains and try to import capital gains from IIFL. So you can go to capital gains, click on add securities. You can say import from my broker and then choose IIFL. And then again, just like we connected to income tax department, we connect to IIFL with your consent. You have to put in either OTP or whatever security mechanism you set up on your IIFL account. You have to give us consent, and then we can import your PNL report. Now, remember, this doesn't give us access to execute anything in your account. It just gives us access to read your PNL reports. You can always go to on Quico My Account section, and you can remove the third-party apps. So you can disconnect your IIFL account from your Quico account. Like you can see, it instantaneously syncs all your settlements onto Quico. It prepares the capital gains summary, and it helps you very easily report it in your income tax return. So not only individual taxpayers love this feature, but tens of thousands of chartered accountants also love this feature and they use it for their customers. Now, I think let's see how. I think business profession income is also can be imported in a similar fashion. So you can say add securities, add entered in F&O income, and you can again connect to your IIFL account and import all the entered in F&O incomes. Can we very quickly go through the review and we can show people how to e-file? So once you click on review, you will have one chance to look at all the data that you have reported. We will show you if there are any errors, warnings. So errors is any reporting data that is missing from your ITR, and warnings are, if there are any inefficiencies in your income tax return. For example, let's say you have reported a capital gains transaction that, in our opinion, was a buyback, and hence it was exempt. Then we'll show it to you as a warning. Then it's your choice whether you want to mark it as buyback or not. I think let's go ahead and will we be able to show them how to e-file it? Cool. So you can click on continue, and then again, you can, by giving us consent, you can directly e-file from Quico, and then you can e-verify from Quico as well by giving the Aadhaar OTP. Right. So it's that easy to file your taxes. Now I want to get to your Q&A so that you get your questions answered. So let's try to. Keshav, do we have questions summarized that we can look? All right. So Keshav has nicely summarized questions for us. What I'll do is if I have already covered it, I'll very quickly refer to it and then move on to the next question. So I've traded in cash market and I have short-term gains. Also did FNO in the month of April, May. Can I file through Quico? All right. Now, of course, you can file through Quico. But just to let you know that, right now, whatever filing you are doing it for financial year 23-24. That is for any activity, any incomes that were accrued between 1st of April 2023 and 31st March 2024. Right? So, like you are saying, if you did an FNO trading between April, May 2023, then you need to report it in that, in the current assessment year, and you can file it through Quico. Now, can FNO losses or gains be set off against bank savings interest and business gains or losses? They absolutely can be, right? Because FNO is considered non-speculative business. It can be set off against any other income except salary. So you can't say कि मेरा 15 लाख का salary and मेरा 15 लाख का FNO का या business का loss है, hence मेरा taxable income 0 है. But otherwise you can set off FNO losses against your capital gains, both short-term and long-term. You can also set off your FNO losses against other incomes like savings interest, you can also dividend incomes. You can also set them off against other business incomes as well. Can we claim LTCG exemption of 1 lakh first and then adjust any carry? Absolutely. So that's how the income tax utilities work. That's how platforms like Quico work. So they'll give you the benefits first before, so for example, you'll get basic exemption benefit first before you get benefit of 1 lakh exemption. Then you will get 1 lakh exemption ka benefit. And then finally, whatever is left will get carried forward. Now, I'm an IFL trading resident account holder at present, NIA status, having mainly monthly rental income from 2 properties. Okay, is it really essential to file ITR and how you can support? Because like I said, because your income is greater than 2.5 lakh, which is the basic exemption limit, or greater than 3 lakh in case of new regime, you must file income tax return in India. It's very easy to do so, let me tell you. If you want to do it through us, then of course you can navigate to quico.com and try to do it yourself. But if you need help, then everywhere you will see a CTA for meet advisory. So you can opt for meet advisory and somebody from our team will kind of help you file your taxes. Now, filing for intraday FNO segment asks for balance sheet, assets and liabilities in Quico. As a salaried person, how should we deal with this? Now, this is a great question. I'm happy that you have gone through it and you understand some of this reporting requirements. So because now intraday and FNO gets recorded as business profession income, whenever you are filing an ITR 3, you also have to furnish your balance sheet and P&L. Now, P&L, we are calculating automatically using your trading activity. However, balance sheet data we don't have, right? What is balance sheet? Balance sheet is your assets and your liabilities. Now, what are your assets? If you are a trader, investor, your assets are your holdings, right? Your assets are your balance with your broker, your bank balance. Your liabilities are, let's say you have borrowed money to trade from friends or family or from a financial institution. That is your liability, right? Your liabilities could be any, let's say any interest that you have to pay to your broker could be your liabilities, right? So you have to furnish this data. Now, today, we don't get all this data because it like while from broker, we can get your holdings, but we don't know your bank balance or we don't know your liability with an NBFC, right? So you will have to furnish your balance sheet yourself. Now, the simplest way to furnish a balance sheet is, for if you don't have very complex situation, then bank balance with broker, and your portfolio value goes on your asset, right? If you don't have any liabilities, that means this was your capital through which you are trading, then Quico will automatically calculate it as your proprietor's capital. That means it's your money that you have brought into the business to do the trading, and hence your business only is liable to you, right? So it will automatically calculate the proprietor's capital as a liability, and you can very easily furnish a balance sheet, right? If you have more complex situations, you have other kind of assets, other kind of liabilities that are related to business. Now, oftentimes people ask me, that I have credit card. Do I have to report outstanding balance on credit card on my balance sheet? You don't, because that is your personal asset and liability, not your business asset and liability. Here, you only have to report your business assets and liabilities when we are talking about specifically ITR 3 and business profession income. Okay, I hope I was able to answer it as much as I can. How many charges? I think today I was here primarily to kind of help untangle taxes. If you navigate to quico.com, the charges are very clearly stated there. And Keshav can also later drop a link, on the YouTube video or wherever this webinar gets posted. But let me tell you, it's pretty affordable because we have automated a lot of things. We have standardized a lot of things. So it's easier for either you to do taxes or even CA within our network to do the taxes. Can we add losses of last year and this year? Of course, those are called brought forward losses. But yes, you are saying missed to mention in last year ITRs. Then it's problematic. If you did not report them in your last year's ITRs and did not carry them forward, then you cannot suddenly magically bring them into your current year's ITR. In order for you to bring forward those losses of previous years, you must have reported them in your previous years. Now, hence, what is your option? Like I was saying, your only option is because यहाँ पे ITR U भी file नहीं हो सकता. ITR U can only be filed when you have you are reporting additional incomes and you are paying additional taxes. I mean, income tax department is smart. Right. So the only option in that case is you have to go to the assessing officer. You can do it online also. You will be able to see my assessing officers under income tax portal. And you can submit them a request saying that because of certain hardships, you were not able to, last few years, a lot of people, because of COVID and other things, were not able to file their taxes. So you can use one of those hardships and request them to allow you to file your income tax return. In that case, you will be able to report them in your previous years, carry them forward, and maybe set them off in the current year. But I think important lesson that if you want to kind of take advantage of any of the losses, you'll have to file a timely return and you'll have to report all the losses. Now, AIS in 26 documents, from where to get it? So you can get it from Quico under tax document section, but you can also get it from income tax portal by logging into your income tax portal and navigating to kind of e-file tab and view file forms where you will be able to find your ITR PDFs and view other forms where you will be able to find Form 26AS and things like that. So you can download it from income tax portal. Can we connect multiple brokers on Quico? Of course, that's our USP. People are able to connect multiple brokers, multiple demat accounts and import data. There are 1,600 brokers, so we are unable to integrate with all of them. We have integrated with top 15 brokers. So you can file your taxes very easily for those brokers. We have historically supported an Excel upload, but we felt that a lot of customers were facing hardships with Excel. So we are reworking that feature. It will be live in next few days. I know it's already late for this tax filing season, but we are still trying to get it out. So people where brokers are not integrated are still able to, report their volumetric data. One thing we've done is you can also do a script-wise entry, right? So what you can do is your total buy as a buy value and total sell as a sell value. You can put a script-wise entry in your capital gains and file your income tax return. So that's already supported. Do you provide tax audit service? We are not a chartered accountants. We are not CA firm. We are a tax platform. So we don't provide tax audit service. However, when you use the platform, we have tax audit recommendation engines, right? Which means whether tax audit is applicable to you can be determined by our platform. And then you have to find out a tax auditor near you. You can also go to our meet and some of our CA partners can assist or guide you if you need help. For income from salary, interest, capital gains, and from profession, which ITR form to be filed? Wow. So in that case, you need to file ITR 3, right? So the way ITR forms work is they are progressive in the sense ITR 1 covers salary, then ITR 2 covers capital gains plus salary, and ITR 3 covers business profession plus capital gains plus salary. So because in your case, it's all three situations, you'll have to file ITR 3. Now that's it, folks. Those are all the things that I wanted to talk about here today. I hope I was able to answer most of the questions. I see a lot of other questions, certain brokers are supported and not. So you can reach out to us on something called text Q&A. If you Google search it, you will find it. You can send us an email at help@quico.com. You can tweet to us. We are looking to integrate with as many platforms as possible. But as you can understand, there are 1,600 brokers in India. It's impossible to integrate with each one of them. So we are trying to figure out how, even when we haven't integrated, how can we make it easy for you to do taxes through Quico? So stay tuned. Those features will be soon available on Quico. Hopefully, your time was well spent. You learned a thing or two about taxes. Happy tax filing season. And I hope this webinar kind of sets you up for the tax filing season, and you will be able to confidently do your taxes. At least you know where to start. And if you are somebody who is a tax geek like I am, then hopefully using this information, you will be able to guide people around you as well. So happy Saturday, happy weekend. This is Vishwajit signing out. Thank you.